Now let's talk about the next strategy, Friday final session. A final session of the week happens on the last trading day of the week. If Friday is a public holiday, this behavior will be seen on Thursday. On other Thursdays as well, this behavior is seen in next week expiry options as the entries in the next expiry is surged during the last session of the market. But with confidence, I can tell you this behavior is usually seen on Friday. When to apply? This strategy can be applied on all last trading day of the week. It usually falls on a Friday. Time. The exact hours will be 2:20 p.m. to 3:20 p.m. on a Friday, with volatility comes to the higher side closer to 305 to 320 p.m. Now let's talk about the process. Step 1. By 1 pm on Friday or the last trading day of the week, note down all the options within 300 strike from the spot at 1 pm. This selection is done on current expiry option. For example, if the spot is 38510, then strike we should choose for this strategies are on the upside 38600, 38700, 38800. On the downside 38400, 38300, 38200. Spot will be 38500. You should consider both put and call option on the mentioned strikes. Step 2. Once these strikes are noted for both call and put option, from 1 pm start noting down the price in every 10 minutes interval. You can use the format shown here. On the first column you have strike, then the option type, then opening price of that particular option, then price at 1 pm. Then every 10 minutes you have to update the price. It will go like price at 1:10 pm, 1:20 pm, so on. It will go up to 3 pm. Step 3. From the table you prepared, note down the price behavior in each option strike. Look for the options where price drop or depreciation is seen considerable. A price drop is considerable when the drop is above 50% or more from the opening price, and continuous drop behavior is seen from 1 pm to 2:40 pm to 3 pm. This can happen on both call side and put side depending upon the market direction, but this strategy should be applied on sideways or flat market with extra caution. In fact, it is better not to apply it in flat market as the target will be. Step 4. Entering. Trade entry should be based on the price drop behavior. If the price depletion is seen on both call and put side, the entry should be very cautious. If the price depletion is seen on either call side or put side, then the entry should be based on the level of drop. The confidence of the entry can be decided upon the drop level, and the drop level is mentioned in the table below. If the in the first column we will mentioning price drop level, and in second column we are mentioning confidence level, and in third column we are mentioning action means entering into the trade. If it's less than 40%, the confidence is very low, it's not recommended to trade. And if it's between 40% and 50%, it's good, also recommended for trading. And if it's between 50% to 60%, it's good and it's the ideal condition. And if it's above 60%, it's a very, you have to enter it with very caution. And it's also, you can make the choice of entry based on drop level. Entry should be made between 2:40 pm and 3:05 pm. The risk travels inversely between 2:40 pm and 3:05 pm, which means you are more likely to make a high risk trade at 2:40 pm levels than the levels closer to 3:05 pm. Based on your risk appetite, you can choose to place your trades. And coming back to exit, under this strategy you can exit the trade within 30 minutes from the entry. Sometimes it can be as short as 5 minutes or less. The comfortable target would be anything between 15 to 40 points. Be it profit or loss, trade under this strategy should be closed before 3:25 pm. You can choose to maintain a 1:3 risk reward ratio.